Welcome back. In the first half, we discussed a strange phenomenon. Despite the Federal Reserve's interest rate cuts, long-term US Treasury yields have risen instead of falling, seemingly defying the Fed's policy intentions. We analyzed the core reason behind this. Out-of-control government debt and concerns about future inflation have resurfaced the bond boxers. So, faced with this situation, will the Fed and the White House sit idly by? What other cards do they have to play? We must recognize that the independence of the Federal Reserve in 2025 is facing unprecedented challenges. The White House's intervention in monetary policy has gone from hints to explicit intervention. Not only has the president publicly called on Powell on social media, urging the slow-moving Fed to cut interest rates, but he has also directly appointed figures like Stephen Miron to the Fed's core decision-making positions. Miron holds very radical views, advocating for using monetary policy as a tool for geopolitical struggles and trade wars. On August 25th, Trump announced on the social media platform Truth Social that he would fire Lisa Cook, the first black woman to serve on the Federal Reserve Board, citing allegations of mortgage fraud. If this were to happen, Trump supporters would hold a majority of seats on the Federal Reserve Board. Combined with the future Fed chair, one can imagine what a thrilling year 2026 will be. This political pressure puts the Federal Reserve in an extremely awkward position. If long-term interest rates remain stubbornly high, the president's much-anticipated economic stimulus will be significantly undermined, as borrowing costs for businesses and mortgage rates for individuals will not actually fall. The president will almost certainly push the Fed to take more aggressive measures. One possibility is a repeat of Operation Twist, the 2011 Bernanke administration. What does Operation Twist mean? Simply put, it involves the Fed selling its holdings of short-term Treasury bonds and using the proceeds to purchase long-term bonds. The goal is to artificially create demand for long-term bonds, thereby forcibly lowering their yields. This sounds like a perfect solution, lowering long-term interest rates without expanding the Fed's overall balance sheet. But as one analyst put it, this central bank manipulation, using newly created money to finance irresponsible deficit spending, is the stuff of troubled third-world countries. Why? Because the side effects of such an operation are enormous. First, it would further undermine the market's price discovery function. Long-term interest rates are supposed to be a thermometer reflecting economic health. If they are forcibly distorted by the central bank, the market loses a crucial signal for assessing risk. Second, it would open the door to even more reckless government borrowing. As the article notes, lowering the cost of federal borrowing makes it easier for Congress to accumulate debt. This is tantamount to handing a stronger bottle of vodka to an already alcoholic. Most importantly, it could trigger a market backlash. If the market concludes that the Fed has become a mere printing machine for the Treasury Department, long-term confidence in the dollar will collapse. At that point, investors might sell off long-term Treasury bonds at a faster pace, causing yields to rebound even more violently, ultimately rendering Operation Twist completely ineffective. As one reader noted in a comment, less than a month after Powell's last rate cut, the 10-year Treasury yield turned upward. Powell wasted his ammunition, so he could find himself in a similar situation, following the yields set by the bond market, only to have them reverse sharply higher. Beyond fundamental analysis, we can also decipher the market's whispers from technical chart patterns. Mike Shedlock's article presents two key charts. Let's examine them together. 30-year Treasury yield chart. This chart shows a very clear, descending triangle pattern. In technical analysis, this pattern is generally considered bearish, meaning that the probability of an eventual downward breakout in yields is higher. This represents the view of the recessionist wing of the market, who believe that a weak labor market will eventually prevail and force yields lower. 10-year Treasury yield chart. This chart can be interpreted as a symmetrical triangle. A symmetrical triangle is a continuation pattern, meaning it's highly likely to continue the previous trend. And what was that previous trend? Consolidation at high levels since January 2025. Therefore, this chart represents the view of the inflation and debt camp in the market, who believe that upward pressure remains. These two charts perfectly illustrate the core contradiction in the current market. On the one hand, shaky economic fundamentals suggest yields should fall. On the other, a mountain of debt supply and inflationary pressures are holding yields firmly in check. Mike Shedlock personally leans toward the former, believing that labor market concerns will eventually outweigh inflation concerns, and the chart will eventually break down. However, he also acknowledges that the Fed's lingering fears from its miscalculation of inflation in 2021 to 2023 may lead them to be more sluggish in cutting interest rates than the market expects, which in turn will support lower long-term yields. However, regardless of which direction the chart breaks in the short term, a longer-term, larger cycle may have already begun. Another reader commented on the 60-year contradiff interest rate cycle, arguing that its bottom occurred in 2020, suggesting that the major trend over the next few decades will be gradually rising interest rates. Combining all our analysis, a clear picture emerges. The Federal Reserve is locked in an unwinnable battle. It finds itself in a challenging position, facing rising inflation risks on one side and a weakening labor market on the other. If it cuts interest rates too quickly and too aggressively to protect jobs, it could easily repeat the mistakes of the 1970s and unleash the inflationary tiger once again. The bond market would then respond with an even more violent sell-off, potentially sending long-term yields soaring uncontrollably. If it maintains high interest rates to combat inflation, the already fragile economy and job market could quickly collapse, triggering a severe recession. At that point, while long-term Treasury yields will fall due to safe haven demand, the stock market and businesses will suffer severely. No matter which option it chooses, it seems to be wrong. The ultimate arbiter of this struggle will not be Powell or the White House, but the silent yet powerful bond market. Its yield trends are coldly telling us a truth. The era of solving problems through printing money and borrowing may truly be coming to an end. For ordinary investors like us, understanding this tug-of-war is crucial. While the stock market revels in the anticipation of rate cuts, don't forget to take a look at the trend of long-term Treasury yields. If they remain elevated, or even rise against the trend, it indicates that the underlying market logic has not changed and risks still lurk beneath the surface. This confrontation between the Fed and the market has only just begun. The coming year of 2026 promises to be thrilling. It foreshadows a period of even greater volatility and unpredictability in global financial markets in the coming years. In this momentous shift, those who can understand the signals sent by the bond market are more likely to survive the storm and even find new opportunities. The above is my personal opinion only and does not constitute investment advice. Thank you for your company.